Hello, everyone. So getting this started, we'll take a minute or two to pull in the whole crew. Um, Getting the whole panel of us on the board as speakers and co-hosts. So yeah, thank you all for joining amidst the earnings drama. I know it could be more fun to just watch Snap go way up, way down, way down, way up, whatever it may be. But glad you're all coming in. I think we'll give it like 2 to 3 minutes to give everyone an opportunity who wants to be here from the beginning to get in, but also know that we are recording this and you'll be able to listen after the fact. So Twitter's got a nice interface for that, but we'll probably also get this out on the podcast This Week in Intelligent Investing, maybe maybe anywhere else that we could. Think it's timely to be talking about this stuff. Didn't exactly know what would happen, though the second Netflix print hit. I had a feeling we'd be exactly where we are, somewhere where we are today. So I think maybe we have enough people in here to at least get the ball rolling, let others come in. We'll still do our intros. I'm here with Jason Moser from the Motley Fool. Great guy. Really looking forward to hearing some of his perspective in the space. Mario Sabelli, sure you all have seen Mario's presence on Twitter as well, but great guy as well, and excited to have him. And Mike Nongap, like the expert in governance, joining us to add his lens as well. Mike's going to go ahead and read a brief disclaimer, and then I'll introduce the topic here, and we'll get going.
Hey guys, little WCM housekeeping here. The securities described do not represent all of the securities purchased, sold, or recommended for client accounts. The listener should not assume that an investment in the securities identified was or will be profitable. That's all I got.
All right, thank you for doing that and getting the formalities out of the way. So, let's get rolling. It's really hard to know to what extent any one stock that's had a very rough year is part of this broader basket of COVID winners now turned losers, or whether that company made strategic missteps along the way. But one of the things that has become clear in this environment is share price declines do actually alter the trajectory of the company. And they create opportunities for investors willing to step in, willing to own some growth on the cheap. And they create questions for management that they need to consider, some questions that are pretty hard. So I've personally, to add my disclosure, I am long shares of PayPal. I possibly overstayed my welcome, but I've had one North Star from the beginning, and I'll talk a little bit about that more later on, but I've long believed that so long as engagement's trending higher, and I'm sure you've heard, if you followed me, you've seen me tweet it, or you've heard me say it on the podcast, whatever, that so long as engagement's trending higher, that's the flywheel of PayPal, because it encourages more merchants to accept PayPal, encourages more opportunities to engage, and adds more value so that more people want to come use the product. But they did get a little in their own way trying to push new actives and maintain some of the momentum from COVID. So one of the first things from the beginning of when I've spoken to PayPal and some other times that I've tried to speak with other people about the company, I've been saying, why don't you all improve disclosure and add some sort of color? And I've to further add context, I've owned shares through the split from eBay. So from the very beginning, I've been saying, show us engagement across cohorts. Tell us what the most engaged users look like, and talk to us about how the average user will be walked up to being the equivalent of the most engaged user, and talk to us about how the most engaged user will be even more engaged. So, we've yet to see any disclosure on that front. And when they held that investor day in February 2021, they sent out a long survey, and I responded with, hey, I love the message generally, but why not any talk about engagement? That should have been your central theme, etc. So that's my brief introduction. I want to open it up to you other guys to add your own intro and, maybe some of your most important points you want to hit on.
I can go first. Yeah, and in fair disclosure, our firm has long PayPal, and we've been a shareholder, since day one, continuously. And I think all of us here have a little bit of a different view on things, so hopefully it'll be a good discussion. But I guess personally, I think PayPal's stock price performance is potentially presenting a new opportunity for the company to break from its most recent past. The company is born of kind of an activist playbook, to some extent. You had the summer of 2015 spinoff from eBay. You had the summer of 2016 piece with the credit card associations that helped create a multi-year tailwind that had some great results, and it culminated in kind of the great COVID acceleration of 2020. And since then, we've seen some cracks, and it's really starting to show some, on growth rates. And to me, the share price, which has been, it's an ugly stock chart, that's for sure. I think it's also potentially opening up a pretty big opportunity to focus on internal value creation. I'm hitting some of I have a number of points to think about, but I'll hit upon the biggest ones: internal value creation, better disclosure for investors, and margin expansion. My instinct is that it's probably time to toss the old playbook out at PayPal and start a new one. And in a bizarre, ironic way, I guess, I think the recent disappointments and ugly stock chart are going to make the organization stronger over the long term. I think there's that opportunity. And I know, like you could say, hey, there's lots of competition. There's been lots of competition for a long time. Maybe it's getting particularly pointed right now, but I'll end with a base underlying assumption that I have, is that PayPal is still a very unique, extremely hard to replicate assets. It's a platform neutral, two-sided brand and payments provider with a massive base of active users that value its core checkout services. So I still think that despite more intense competition, buy now, pay later, more buttons, Amazon's announcement today, notwithstanding everything, that it still holds a very unique space in the ecosystem. And my hope and expectation is that the recent decline is going to open up an opportunity for some real change here. And I'll stop there.
I'll jump in here real quick. I'm Jason Moser with Motley Fool, and have been following PayPal for essentially since the spinoff. It's a company we've recommended in a number of our services at work, one that I own personally, one that I've recommended in one of my services as well. And I think, Mario and I get to talk a pretty good bit about it, among other things. I tend to agree with him for, while this is a very difficult time, you see a business like this that the blunders are really self-inflicted, right? I mean, it does feel like much of this is self-inflicted, which leads me to believe that it's fairly correctable. It does feel like, and we've seen this, I think, with a number of management teams over the past couple of years. We've seen in the past, you brought up Netflix, and it just kind of made me think of Netflix's little hiccups along the way, like the Quickster moment and whatnot. It feels like sometimes management can maybe buy a little bit too much into their own hype, and they feel like things are going so well that they're not really keeping their eye on the ball, so to speak. And it feels like maybe that's where this management team had gotten. Maybe they felt like things were going so well that we could just take them at their word and everything would be fine. But this most recent quarter for me, one of the things, I mean, to Mario's point about this large network, this massive network of users, I mean, that there really is something to that. I mean, you've got this 426 million they announced in the most recent quarter, but I think to me that was also the story in that they noted really it is it's a smaller swath of that large user base that's really responsible for most of their money. and so you getting I think more clarity on engagement, power users versus regular users. I mean, we hear a lot of this talk about the super app, but you're not really seeing, they're not really painting the picture of what that super app means and ultimately what they're trying to do with it. But you've got this collection of really impressive businesses in PayPal, and Venmo, and then also Zoom, which Mario and I have a funny background on Zoom as well. We were following that business, I think, pretty much from its inception until PayPal stole it for a song, and now you just don't really hear much about it anymore. And now you've got a company out there in Remitly, where it feels like you're hearing more about Remitly than you're hearing about Zoom. And I mean, outbound remittance is just a tremendous market. And so it does feel like the disclosure, breaking things out to give us an idea of how each facet of the business is performing, I think it'd be really helpful. Because I will say, and then I'll hand this off. But one thing I had been digging into just over the past several years, you look at a business like this and you look at their take rate, because that's ultimately something that matters a lot, right? I mean, they're pushing through $1 trillion plus through that network, and ultimately you want to understand where that take rate is, because it does feel like the long-term dynamics of this market, the costs of moving money for the most part seem to be just continuing to come down. I mean, you look at the end of the fourth quarter in 2017 for PayPal, the total take rate was 3%. Well, in the fourth quarter of 2021, their total take rate was 2.04%. So it is something I think to at least keep in mind. And if we can understand exactly what's dictating that and where the opportunities may exist, I think that probably gives a little bit more clarity and understanding where they're trying to go. But I'll leave it there and hand it off.
So I think I'm in charge of governance. I just wanted to hang out with y'all and jam. I think more candidly, I'm probably on because I'm prone to speak more freely and may or may not throw a grenade here or there. I think high level, how do we think about this? In general, whether it's PayPal or any other company, and I would say this is probably the case for a lot of these kind of growth um, companies across the board. You've spent the last few years kind of this go for growth. You're rewarded on expanding your addressable markets and exploring all these different opportunities, and you get into these sort of market environments where that isn't exactly rewarded, and you're moving towards more of a cash flow disciplined, thoughtful capital allocation sort of perspective. And I think in general, when you think about kind of that deleverage, whether fundamental deleverage, but also just kind of market environment, getting an organization to kind of shift from one mindset to the other is quite hard. And then you kind of roll that up to kind of the boardroom. It's quite difficult. And someone like PayPal, who I would say is probably considered, prior to the last few quarters, kind of one of those white shoes, high quality sort of businesses that a lot of folks would want to be on the board on. And you certainly see that with the directors that are on the board. Anytime you're in a situation where you're going from cruise control to how do I want to describe this, to essentially a cannonball run, so to speak, where there's a lot of things that need to be addressed. There's a lot of hard decisions that have to be put in. It takes a certain mindset. This is why a lot of directors kind of hate, I wouldn't necessarily call it a turnaround, but no one wants to take on these hard decisions. No one wants to really put in that level of work relative to kind of what they signed up for, if you will. I'm not saying anyone at PayPal feels this way. This is kind of in general. I think as you think forward over the next few months, there are fundamental factors in play, and from a governance perspective, there's certainly some areas where they need to address some compensation and probably board composition sort of dynamics that we may or may not get into here, but I think it's fair to say that this particular name and the leadership here, like you probably should have some level of concern for activism, for something potentially happening later in the year. I'm not saying I know anything about that, but I've been through enough rodeos to know that these sort of assets don't typically get ignored by activists, especially at these valuations. So happy to dive in from there, but all yours, Elliot.
All right. Yeah, no, so good to get started. Thank you guys each for sharing your perspective. And I should have said at the top, once we go through our stuff, we'll open this up for Q&A and let you all listening ask some questions or share some perspective as well. I think this is a good launching point, and we had a couple bullet points outlined that we'd kind of hit on from how they could improve disclosures to what the M&A and internal growth focus should look like, down to culture. So maybe Mario, do you want to talk about some disclosures at first?
Yeah, I think I'd like to, and I'm going to attempt not to toss any grenades. We'll let Mike do that. But I'll try to speak freely here. And I do think the company is, I think it's quite clearly at some crossroads, and I do think that the quality of the asset, even though it's a controversial company, I guess at least on FinTwit it seems to be. I do think there's a body of investors that consider it a pretty high quality asset. And, we were kind of joking around a little bit before about, the current market dynamics. It is a gap earner, and it does generate a lot of free cash. So it is not, a future profit pool that you have to wonder about is their profitability there. Of course, you have to worry about the growth rate and all that kind of stuff and rising competition. But it has one foot squarely in the gap earnings camp, which is kind of an interesting dynamic here. But on there's a couple major pieces. I do think the refocus on organic growth and innovation is very important. But arguably number one or number two between that and improved disclosure, I wouldn't know which one kind of to say which is most important. I would say improved disclosure is well, they're going to be one or two, and improving disclosure is not the most difficult thing to do. Having the company tilt towards more rapid innovation and product improvement, can't fully be controlled, but improved disclosure can be. So I'd say maybe we'll put it at the number one topic here, almost to some extent, which is things that can be done to better investor understanding of the business and what's going on, and I'll be, specific. So I don't think personally, I don't think it ever made much sense to commingle the consumer checkout services with merchant processing services, and I think that was acceptable because the bottom line result, including the gap results, were attractive enough and headed in the right direction that no one really gave them too much of a hard time about it. I do think at this point there needs to be a break, that investors need to, and I'm not going to be so specific on this because there's some complexity to it, but generally speaking, I would kind of say the core consumer checkout services and the merchant processing services, those should be broken out, both in revenues and with some operating expense breakout to give us an idea of what those businesses look like. I think much better bucketing on TPV, and whether that's a one-time kind of look at a point in time or if that's a continuing look, I'm not exactly sure, but I think they owe shareholders a much better look into how that is segmented, across remittance, across peer-to-peer, across core checkout services and kind of merchant processing. Monthly active users, I think, kind of makes sense at this point. And I'll say this last point on improved disclosures, in the form of a question. Is it time to drop the non-GAAP earnings? Non-GAAP may have an opinion on that. We'll see. Ignoring stock-based compensation, naturally desensitizes one to it, and it's a real cost. We all know that SBC is a real expense, and I think PayPal is mature enough now that it may be time to drop that. Now it shouldn't be that controversial. They give both GAAP and non-GAAP, but there's a continual kind of emphasis on non-GAAP numbers, And look, over time, it's very important to leverage all lines in the operating expenses, including SBC. So I asked that in the form of a question. I think it may be time. So I think this is it's a very, very critical topic. It's not the most difficult thing to get right. I think it's far more difficult for the company to innovate and come up with a much better product that kind of helps drive earnings that way. So this is something that it's kind of a relatively easy thing to do, and they'll have to decide exactly what they want to give and how much of look they want to give. But it also, I think, the company, I believe, has referenced mix shift a number of times on margins. And if this is done right, well, they should be able to make clear that on core consumer checkout services, additional volume over those rails should come in, more profitably. And then you don't have to worry about the mix on that side. So I do think this is a critical area. I think it's a must do, and my instinct would be, is the company, I think they're signaling this and discussing this with shareholders that they're very open to doing this. And those are some specific things. Anyone else? Did I miss anything on what additional disclosures should be, or leave anything out, or what some of the ramifications of that may be?
Yeah, I mean, maybe to give more color from PayPal on to what extent the button is the source of action in a given transaction, because that's truly where they add unique value. It always latched on to this Ready quote that what they're selling is conversion, not commoditized payments. And that's where they're most differentiated. But I'd really also personally wail away at this notion that they should really disclose like the level of engagement in their user base across cohorts and get a clear sense, because PayPal's been controversial from the first day I used the company and first day I invest in the company, because a lot of people fundamentally don't understand why there's value for a certain, why the user base sees it as valuable. There's some people that question why PayPal needs to exist. People question button proliferation, etc. And meanwhile, there's a group of users out there. And I like that you said disclose MAUs, Mario, because that's especially enlightening. But there's a group of users out there who fundamentally rely on PayPal. And they do so for a confluence of reasons. Many people start with something like security and ease and trust. But the reasons start multiplying. And that creates opportunities for PayPal to develop product around it too, or to formulate incentives. One of the other ideas that I'd questioned and pushed them on is this notion that, every many great marketplaces grease the wheels of one side of their user base. And PayPal is unique as a payment platform where they have both consumers and merchants. And if you understood why the most engaged users do so accordingly, you could start studying and doing things like pay your Netflix a monthly bill with PayPal, and we'll give you 1 month free if you set us as your default payment mechanism. And what do you get? Well, you get good frequency that's basically what was there when PayPal, shortly before PayPal was spun off. And you get this like trust and build motion. And they've been reluctant to use rewards, which is something I think a lot of people see as core to any payments experience today. So with disclosure, you could start telling these stories and paint better pictures. And I think you'd have a very fundamentally different approach to strategy than you would without having to talk about these things. And I think to an extent, there's an arrogance behind not disclosing these numbers, where when things are going well, you don't really have to talk about these things. You don't have to show a little more. But when things are not going as well, I think you do have to consider that. And, I'll stop now. Jason, I saw you had something to add as well.
Yeah, I mean, I think you're spot on there. I mean, it reminds me, and I'm going to give Mario the hat tip here, because this is a hack that he taught me some time ago that is just really helpful. But talking about using PayPal to pay for your Netflix or whatever it may be, and one thing that Mario taught me was you just any subscription that you have, virtually everything that you can run through your PayPal account, do that, because you can centralize it all. So it's all going through that PayPal account, and just whatever you're paying through that. Like I have my primary payment is linked to my Visa Amazon Prime card. But the point is that, like, when that card expires, you don't have to go to 10 different websites to update your payment information. You can just update it at that one core PayPal hub. But to the point on disclosure, I mean, I think that's spot on. I mean, I think there's a level of arrogance that comes with not disclosing stuff like that, particularly when you become more things, right? I mean, it's not just PayPal anymore. Like, there are a lot of moving parts to this business. And so, if you look back through the history of earnings calls, I mean, analysts typically have to kind of go in there in during the Q&A, make some guesses on where engagement is doing well and where it's underperforming. And even then, management not necessarily all that forthright with the information that they're giving. And so, if you're going to tout this super app that can do all of these different things, well, it only seems reasonable to then say, well, this is how all of these different things are doing, right? Because PayPal is something we all kind of know, but there's this other facet to the business that the younger generation's coming up on, and Venmo. And I mean, at what point, does Venmo become sort of, the Instagram of Facebook, right? I mean, at what point is Venmo now really the core part of this business, if it ever is? You want to have a better idea of how that's all working together. And I mean, obviously Zoom, you've got Honey in there. I mean, you don't really hear much on how all of these pieces are coming together. And then just, one final point, I think on the share repurchases, it is. I mean, I think we're always going to be living in kind of a non-GAAP world. But I mean, to that point, just looking at the share count, I mean, the share count since the end of 2016 is down 3.5%. It's down. They brought it down by about 42.6 million shares, and they spent $14.7 billion. So, like, if you do the math there, you can see what they're now. There's some acquisitions, of course, along the way where that was impacted, and certainly stock-based compensation. But it is all to say that, you can make the argument that these share repurchases haven't necessarily been terribly opportunistic or rewarding, where maybe they could have taken a little bit of a different view. And I guess one thing, I kind of want to pass this to Mike just to get his opinion, because it to me, talking about activism, it almost feels like that is sort of a, it's almost, I don't want to say it makes this a risk-free situation, but it's almost like the worst case scenario. If management continues bungling this, I mean, an activist comes in here to try to change things around. I mean, it's hard to imagine. It's hard to imagine PayPal, the stock, suffering from someone coming in there and really finally calling management on what it's been doing. I don't know, Mike, if you have any opinion on that.
Opinions. I might have a few opinions. I mean, I guess maybe just to like summarize this whole section about disclosure, improving disclosure. So what's the point of improving disclosure? And like for me, at the end of the day, if the best way to have proper oversight and accountability is disclosing the things that investors and ideally the board cares about, that actually drives value, that they're the key levers. And yes, you can get away with kind of hiding certain metrics and numbers when things are going well, and sometimes you might even do it for competitive reasons. If things are doing exceptional, you don't want others to know. But if you're in this kind of situation, and hypothetically, if an activist were on the board, this disclosure would probably be one of the first things they would ask, in the sense of trying to better understand what are kind of puts and takes of the core and key assets within this business. And I'll wrap up with just a very, very generalized story about activism in the boardroom. And it's, most people think it's magic and you're doing this hard differentiated sort of work, but oftentimes what it is you're just kind of addressing the obvious. And what I mean is, if you're frustrated as an investor with like poor disclosures and you're not getting the right information, odds are the board isn't really getting that much more insight on things, because if you're communicating certain things to the street, board's probably getting something similar. And it isn't uncommon to enter a board situation and ask for something like, hey, can you give me customer level profitability on these different businesses? And that's a question that literally would never be asked in the boardroom. You would think they would ask, but there is kind of this inertia to not kind of point out the obvious for a whole host of different reasons. But the first step to driving more accountability and oversight, it starts with what are the right sort of metrics being disclosed. I guess to the point of like non-GAAP versus GAAP earnings, it's I kind of go back and forth on it. I'm okay with non-GAAP as long as, well, obviously I'm okay with non-GAAP, but I think that there are probably other ways to drive more alignment and accountability. Just you can certainly use a non-GAAP number, especially if you're tying your compensation in a fair and reasonable way. But on the flip side, I mean, these guys were using your free cash flow CAGR as a compensation metric, which objectively is pretty decent. It's not bad, to use free cash flow, and you would think that would help drive long-term value. But if you're setting your free cash flow CAGR to what's their last tranche, 4% target, 5%, 200% payout, okay, I would rather you address that versus trying to sort out GAAP versus non-GAAP at this point. There are actually much bigger issues to address potentially from a comp and governance perspective. But oftentimes it does start with what are the appropriate metrics we should be prioritizing, and then start implementing kind of the right set of incentives and oversight at the board level to kind of drive that alignment.
Yeah, I just got to make a comment here. I'm probably the biggest super user here. If there's anyone in this space that does more transactions for me on PayPal per month, I'd be shocked. So I want everyone to kind of behave like me. And it was kind of, as Jason said, serendipitous that I discovered this little bit of a hack because of a situation I had with a credit card where it took me two and a half months to fully replicate kind of my new form of payment after a fraud. So I kind of came to the conclusion with PayPal, my PayPal wallet, doesn't cost me anything. And it provides an added layer of security and benefit. And in some circumstances, the case where I want to swap one card to another, it's an absolute home run. So I would be among PayPal's most active users. And then as we were talking about before, on the innovation side, essentially, and the management, kind of talked about this on the last call, how to get more of the active users to engage like the super active users, and just my instinct is, and this might get into a little bit of a different topic with the company's focus historically on, a lot of M&A, and they do look at a ton of deals, that the mindset to think really hard about how to get the active users to behave more like the super active users, including loyalty, including maybe preferential kind of treatment for high frequency apps such as Uber or Seamless, Grubhub, DoorDash, or rideshare, Uber. I won't mention Uber's competitor. I'm an Uber fan. That those should be high priority things. And I do wonder sometimes if the company has been as focused on internal innovation and getting people, the active, to behave, like the most active users. It's almost natural that gets a little bit of less of a look than it would otherwise for a team that is very focused on M&A and being a super app and adding, maybe some other kinds of services that are a bit off the core. I'm opening myself up to some criticism there because, the company has clearly added some elements to its wallet that has driven engagement. But I do think, a very important feature here potentially is that, PayPal is going to have to figure out how to grow internally. without relying on external M&A, much more so than it has, over the past 6 to 7 years. I think that is a potentially very good thing. I don't think things like that, what's in the DNA and what's in the culture, it doesn't turn on a dime. But that could be a very, very valuable thing to lean into here.
Well, and Mario, to your point, I mean, I do think there's signs, at least, that they have. I mean, obviously, they have the ability to innovate and to make things happen relatively quickly. I mean, you look at their buy now, pay later offering, right? I mean, I think, of course, they made an acquisition there in Paydi, which I think is based in Japan, if I'm not mistaken. But I mean, they were talking about, they essentially built this sort of homegrown BNPL offering that pushed through $3.2 billion of total payment volume over the last quarter. So it was, I mean, I found that encouraging for, as you said, a company that has a history of making acquisitions and kind of not necessarily focusing on growing so organically. I mean, it was encouraging, at least, to see they were able to experiment and sort of build that from the ground up to an extent, at least, and witness some success. Now, I mean, I guess it remains to be seen exactly how the BNPL market shakes out. I'm not entirely sure there, but another thing that we were talking about this morning was this Amazon news of the buy with Prime, which ultimately extends that Prime shopping benefits to the third party partners with Amazon. And I was just thinking about how this could be an incremental benefit for something like a PayPal, because they're incorporating that Venmo payment option, and ultimately, and it depends on how this buy with Prime feature rolls out, but you could certainly see folks who use their Venmo as their primary payment option for their Amazon purchases. I mean, if that extends out to many more partners beyond just Amazon, I mean, there's certainly the potential there for some incremental benefit as well. It just kind of made me think bigger picture. Like you've seen PayPal kind of extricating itself from this relationship with eBay, which his I think was the right thing to do, obviously. But it'll be interesting to see if we're not talking about further down the road them partnering up more with something like an Amazon. I mean, that might not necessarily be such a bad thing, given Amazon's scale and obviously the size of its third party network as well.
Yeah, no, some really good points, guys. And I think part of why the next chapter was an appealing title is like no longer being in the relationship. The post-split relationship with eBay gives them a degree of freedom they hadn't had before. But I want to hit on some of these innovation points, because to me, this is a critical factor that the management team needs to focus on. And, all the credit in the world for BNPL, I view that as fast copying more so than outright innovation. And it's great because they have massive distribution on both sides, consumer and merchant. So use that scale and push it out there. Exactly what you'd want to see. Good. Bitcoin, they got there fairly fast in a relative sense, perhaps. But I think what they did interestingly fast was to actually use Bitcoin as a funding instrument. I think that's a good start. But otherwise, I've viewed innovation as a somewhat critical, I don't want to use the word failure, but a critical missed opportunity for PayPal. And there are some signs it's getting better, but I want to hit on a little of the history here. So when Schulman first took over, he used this story about how the scale of technology enables you to drive costs down in areas the financial industry has historically overcharged, especially those who are underbanked. And, I think it was very second transaction. So not Zoom, but the second one was TIO Networks. And both Zoom and TIO have like a very close nexus to this theme. The problem was TIO itself had to be shut down within a year of acquiring it because they missed in their diligence a critical security failing. And Zoom took a lot longer to integrate technologically than they'd expected. But otherwise, it was actually Square in the Cash App that started innovating. And if you look at the relative demographics of Cash App versus core PayPal Blue or versus Venmo in particular, Square's actually won with underbanked constituencies, doing so directly with product innovation. And I'd recently spoken with a former executive based in an emerging market, and he said one of the critical failings of PayPal in his market in particular was this idea that the development at the company had been centralized in San Francisco. And to actually succeed in a lot of these markets, they need a hybrid development model. And that would actually facilitate even better innovation because you'd have people on the ground in a variety of areas sensitive to technological changes, regulatory shifts, and product development that can be co-opted and not co-opted, wrong word, co-opted, but that can be learned about and deployed across all of PayPal, not necessarily just in those geographies. So I'd say, in those three ways, I've been pretty disappointed in PayPal's innovation. This talk about a super app, I'd really rather them use the phrase, we want to be a even neobank or a fully functional, so going beyond a digital wallet, but being like a bank on your phone, more so than just a super app. That would be my preference. And I think that would be a better narrative, and it would be more logical in terms of the kind of product vectors you need to explore. And you wouldn't end up in this, oh, should they or shouldn't they buy Pinterest, despite some of the thoughts I tweeted out at the time. But you'd have a much more singular, clean focus on going down the building functional financial product to drive costs down with the scale of technology, Schulman's original mission, which I'd like to see more on. So that's my spiel on innovation.
Yeah, I think innovation is it's so important here, and my instinct is the company is going to start pointing in the right direction. And look, I think de-emphasizing M&A, especially large scale and non-core transactions, is part and parcel with that. I just think I don't think you could deny that with such a intense focus on M&A over the years, and think of how many deals they pass on and look at and think about hard that they don't actually end up doing. It has to come at some cost to the organization in terms of innovation and internal growth. They do have a massive opportunity here, in my opinion. So Elliot and you and I have riffed back and forth some on loyalty in transitioning to super users. Of course, management signaled this again. Don't pay as much attention to NNAs. We have this super active user base, and we need to figure out how to make more of them. From the monthly actives and push them into this very super active category. I think that is so important. It could make all the difference in the world, and I think when the organization really gets focused on that and buys into that, and then there's incentives around that it could make for just a great outcome over time.
Mike, why don't you tell us a little bit more about this free cash flow target and perhaps some of the misalignment that's going on with PayPal's incentive structure, and maybe what a better board could do or would look like in this case?
Well, I mean, I don't want to say a better board, because I think oftentimes boards kind of know what needs to happen and will often not address it, again, for a whole host of reasons. But when I think about like incentives and kind of how that drives certain outcomes, again, like when a company is doing well, most folks aren't going to pay attention to these things. But the second there's a step down in performance or a massive sell off, suddenly everything is scrutinized, right? And that's kind of the nature of the beast, so to speak, right? You're either fat and happy, or you're broken up and in the gym and on a diet, so to speak. So when you think about like Schulman gets paid quite a bit of money. I think that's kind of fair to say. And obviously when you kind of compare him to peer groups, they would say it's in line. But one of the things I like to check when it comes to, is this board and management team kind of aligned, but also like, is there a fair level of like accountability going on? Is to really compare, what are sort of the kind of outlook or guidance they're offering to, investors, and how does that compare to, how management is paid? And in general, you kind of want that aligned in the sense that if a management team is saying they plan to grow, let's say, 16, 17, 18% over the next, 3 to 5 years, you would hope their target comp is tied to that sort of, transparent disclosure. Oftentimes, and this is a personal kind of anecdote in my experience, you get these dynamics where, the management team will share certain metrics. So in this case, I think I'm looking at, which I'll actually use a real example here. So PayPal, right? So you think about like the 2018 to 2020, performance-based RSUs. Half of it's tied to kind of revenue CAGR, and the other half is tied to free cash flow CAGR. And this was around the time that the company was sharing some 3 to 5 year kind of growth outlooks. And correct me if I'm wrong, Elliot, but I believe they were kind of guiding, I think, like 17, 18 percent sort of growth.
Yep.
And free cash flow yield, I think, was supposed to be like 20+%. So when you kind of back into that, if free cash flow CAGR, that off that yield would have signaled like I want to say like a 30% sort of growth guide. And so when you kind of look at the tranche that aligns with that guidance, their target was 14% revenue CAGR, and their free cash flow CAGR was 29%. Okay, that's fair. But when you look at kind of the 200% payout for that equity, it's at 16% versus kind of that's below kind of what they were already guiding to the market. And then free cash flow CAGR was kind of in line with the free cash flow yield guide. And so when you get in these dynamics where this is our kind of targeted growth and we get paid out at 200%, mind you, I don't mind seeing management teams get rewarded for their execution, but that's sort of like misalignment where, hey, the market's going to start pricing in these sort of like trajectories and outlooks. And if you don't execute against that, like you potentially get these meaningful haircuts, whatever that might be, 20, 30, maybe even cut in half. And despite that, you then still end up in this dynamic where the management team still gets paid 100+% on their targets, because their targets are below what they're even stating. And kind of that misalignment, I know it's like, what's the big deal is often what I get from folks in the past when I point this out. And the big deal is when you allow a comp structure to be set up that way, it's kind of signaling certain things as far as how management and the board are working together. But also this goes back to accountability, right? This goes back to proper oversight. If you're telling the street one thing but getting paid below those levels, hitting numbers below those levels, that it just creates this distortive effect that might not show itself when things are good, but when things get bad, it becomes pretty obvious. And I mean, and then the other issue too is the consistency of the hurdles being applied. So we're talking 2018 to 2020 being, let's say, 29%, 30% CAGR, and then like the following year's tranche, free cash flow CAGR, threshold was 3%, and you got paid 200% at 5% free cash flow CAGR. First of all, like low single digit free cash flow CAGR just seems kind of, there's a lot of room to kind of, I guess gaming is not the right word, but you start wondering like why even bother using free cash flow CAGR at that point? Like, this is certainly indicating there's some sort of investment, there's something else that maybe will be a more appropriate metric to measure the management team against versus, oh, by the way, if you hit 4% free cash flow CAGR, you get target payout. But if you go from 4 to 5%, we're going to double your payout. Like that range, first of all, is weird, and it's just kind of like unusually tight. Like who, like if you're on the board, if you're on the comp committee, like how do you even like debate that? How do you even have a proper conversation about like, what's appropriate, well, our last year's grant was tied to a 29% CAGR and now it's 4%, that's kind of a weird thing to, talk about. And then that alone starts, forcing you to ask questions as far as, okay, well, your target is, let's say 20 million, but if you're getting paid 200% on that, like maybe it's closer to, your all-in column is actually closer to 30 to 40 million off some pretty, like achievable hurdles here. So when I talk about like, GAAP versus non-GAAP or all the different metrics, like sometimes it's not the metrics, but like what you're holding, like what the actual target is that you're holding the management team against. And if you're doing these sort of, incentives and, like in general, this is something that like the proxy advisors and ESG folks don't really like hammer these folks on, but it's, from an investor perspective, like you should be voting against this sort of structure, period. Like this actually should not be something that is encouraged, but it is when things are good. But you could make an argument that you should vote against the chair of the comp committee on these sort of dynamics, or at the very least hey, let's have it more aligned with what you're telling the street, and that requires paying out more compensation at target, then so be it. But at least it's aligned. They're not going to do that because then Glass Lewis is going to, and ISS are going to give them a hard time on burn rates and comp numbers. But again, this is one of those things that a lot of companies do to kind of get around the burn and kind of gross dollar headline numbers. I mean, he's getting paid 32 million or something, I think, a total comp. But I think if you're actually going to use the kind of whispered target comp that they're trying to give this guy, it's probably closer to 40, 45, right? So, and that would be pretty, the headline's pretty egregious, but like, they're doing it in a way where they don't have to disclose the actual number they're trying to pay out this person. But even having that philosophy, even having that kind of like mentality can be quite, if you're an investor, that could be very like concerning that you're even entertaining that sort of mindset, in your comp committee, if you will, even if you're just trying to like get around certain, ISS or Glass Lewis metrics. I mean, this is, it's always in the incremental loopholes that you're trying to like, get around stuff that you learn a lot about management teams and boards. But I'll stop there because I could probably spend the next 2 hours talking about how everyone needs to probably like refresh this board potentially. But
I was just going to say, Mike, the payment CEOs aren't they're not known for being underpaid, and so that's certainly gets someone's attention here. And I do think the results, over time have been so good that, there probably hasn't been a ton of focus there. I do think, like the quality of the asset, what you're saying, the recent, decline in valuation and the share price, 2 quarters in a row of bringing down numbers, maybe 3, hopefully not. Yes, there are external factors, but it is all adding up, to create an environment. We have a single class of shares here. I would say for sure there's some vulnerability here, to an activist or a suggestivist, so someone that, may have a different view. My instinct would be is that the management team would have a sense of this, would understand that, and I do think that a form of advice might be, hey, consider running the activist playbook before someone runs it on you. I think that would be potentially wise in this case. But I do think there's vulnerabilities.
I could probably make an argument that there probably would be an activist here in the sense that when you look at kind of the nomination window on this thing, I think it was like mid-December to mid-January, which is atypical in the sense that like I feel like oftentimes investors or activists want to see kind of Q4 results and kind of the go forward outlook and then make a determination on submitting a slate, right? Like it's not very often you have to like submit a slate or get engaged before Q4 earnings, right? There's certain risk factors and things like that, and that's kind of unique to this company here. If PayPal had a more kind of typical nomination window, which typically would overlap with Q4 earnings, you would have probably till early March to submit a slate. I mean, there's a very good chance there'd be an activist involved publicly right now, but that's not the case. So, I do think there are like actually quite a few very obvious kind of levers and potential vulnerabilities just from a governance and assuming there's an activist that would be interested in this and their levers to unlock value. It's not. It's probably not a situation that the management team wants to be in, but it's certainly something. I mean, if I would put it this way, if I were in that world of activism, this seems like one of those names I should be spending time on, because to your point, not only is this business kind of have gap earnings or can generate a return, but this isn't like a dynamic where only one or two CEOs can run this asset. There are probably a lot of interested parties as far as what they could potentially do with PayPal that are going to have certain opinions on how to fix the business. Maybe some of them are right, maybe some of them are wrong, but if you were to kind of submit a slate, there are a few things you can address: the disproportionate kind of comp hurdles, right? Like kind of the lower hurdle relative to expectations. You can probably make an argument that some directors really shouldn't even be on the board for various kind of legacy reasons, and maybe when I look at this board, it's you have folks that I know they mention payments expertise, but do we really have the appropriate level of payments expertise on this board to offer oversight? I don't know. I mean, but if an activist were to introduce a slate with a pretty compelling composition of understanding where the puck is going and technologists and so on and so forth, it becomes a very pretty compelling case. And I'm kind of shooting off the hip right now, but it is kind of one of those things for this year where it's kind of execute or you're probably come fall. This is I mean, the other compelling thing is you could probably put a lot of money to work on this thing, right? Like it's a large asset. There's if the valuations kind of persist at in a way that someone can raise potentially a lot of capital to go after it, show me the incentive, I'll show the outcome, right? Like there's someone's going to try that.
Yeah, I hear a lot of what you said. Of course, we mostly are suggestivists behind the scenes. Our fund has done one proxy fight in one and settled another one with good outcomes. And my instinct here is that this management team is sophisticated, is smart. They have good advisors, and my instinct would be is that they probably already understand that there's time. It's time for some change. I'm hopeful there. So I don't know if Jason or Elliot, you have any thoughts on this angle?
Well, I mean, I think generally just based on, the discussions we've had before leading up to this, I mean, I tend to agree with you. I mean, I feel like we're at a point where, I mean, this is obviously a very valuable asset, very valuable collection of assets. And I mean, you get to a point where, someone's going to say, or a collective is going to say, look, fix this, or we're going to come in here and fix it for you. I think you're absolutely correct in that it's not like there's one or two people that could run this company. I'm certain there are a lot of people out there with a lot of great ideas that would love the opportunity to try to take this to the next level. So that's again where I look at the, you look at all of the challenges, you understand that a lot of it is self-inflicted. I mean, steer that attention away from the M&A. Don't focus on that. There's such a cost to that strategy, and organic growth and innovation just suffers so greatly. You don't see it at the moment, but when you look back over time, you recognize that it's time and it's money that was just not invested correctly. So it does feel like one of those situations, given the state of the business, given the size of the net worth, the value of the assets. I mean, the risk reward. I mean, looking at this just from an investor's perspective, it really does look like one of those risk reward scenarios for investors today that it looks pretty darn attractive, but I mean, it obviously comes with some execution risks.
Yeah, well said. And, I'd say one of the things that irks me most that Mike put on the table is this idea that the free cash flow CAGR target was less than 1/3 that of the revenue target, while, the management team was talking about how much operating leverage is in the business. Well, if your incentive is geared exactly the opposite way, you're probably not going to focus on and optimize for that target. And you could ask other questions about how much they should be investing in growth and whatnot. But, that's the game they're publicly talking. And they did, to a great degree, realize that, especially into COVID. And now some of it's reversing. But, it would be nice to align the actual comp structure with where they say they should be going. And it's, probably worth mentioning. I've viewed John Rainey is a pretty key figure here, and it's hard to blame him for wanting to go to Walmart. But, that does probably leave some of the investor community who's built a lot of trust in Rainey some questions. When Dan's been maybe at times a little loose with language. I recall after the Q4 2016 and early 2017 earnings report, saying that they're near a partnership with Amazon, and then within a few hours having to put out a release saying, no, actually, we're not. Like, you can't do those kinds of things. So I think a lot of trust had been placed in the team in general, and there's reason to trust Dan too, but I think Rainey had been pretty critical in that. So right now they're looking for a new CFO, and they should be thinking about some of these questions we're raising here. Maybe if any of you guys have any last remarks in the formal part, go ahead. If not, we could open it up to Q&A. So if you got questions, start building in the queue.
I have just two little other things I've kind of thought about. I think operating excellence could matter an awful lot here. If with the core checkout services, the additional volume in the core checkout services compounded over a couple of years. So staying away from kind of the merchant processing side, and ignoring kind of the mix on the core service. There really ought to be some margin expansion, and if there's not, there ought to be a really good reason for it. It's a massive de-risking component for shareholders. If we can get some margin expansion in that business, and significant margin expansion, and you would think, payments is the kind of space that should occur. It's wildly important for shareholders. It de-risks the earnings growth compounded over time in a very, very big way. So I do think, I guess if I were to stereotype a bit about companies on the West Coast, companies that are focused on growth, yes, they're focused on innovation, but they sometimes tend to do that at the expense of really kind of allowing additional flow through on revenue growth. Do I worry about that a bit here? So that would be an interesting dynamic, for a renewed focus on expansion of margins, especially if we would kind of isolate for mix issues. The other small thing two small things I was like, if we are going to be a lot less focused on M&A, we do have a good balance sheet. We're generating a lot of cash. Might this be time for share repurchases that are not done at any price to offset dilution, that we're more opportunistic, and this is a very good price potentially to retire a significant amount of shares. That's interesting. And the last little one I was going to mention, that Jason brought up was, I have thought about, are there any divestitures here? And one that kind of potentially makes sense to me is, and I don't know if it's feasible because I don't know how deeply integrated it's become now, but Zoom to Remitly for shares in the combined organization with the level of advertising spend that those two companies do together, I think could create, a very much a winner in the digital remittance space. And, that's a very interesting space kind of over time. I also think it would be, it's not a huge deal, but it would also send a very strong signal to the investment community that the old playbook is potentially out. I do have, we do have investment in Remitly as well, so fair disclosure there. I think the combination of those two businesses would potentially create a really nice winner in the digital remittance space. And I bat that one around as a small one I've thought about, but could also send some very good signals to the investment community.
All right, well said. So if there's anyone out there, I haven't seen anyone populate the queue with some questions. We'll maybe give it a minute. We have a couple minutes that we could, sit here and answer some questions. If not, I'm sure. I hope I'm not speaking too freely for everyone, but we are all willing to engage on Twitter. So if you want to bring the questions to the feed, by all means, take it out there. And appreciate you all for joining this. This was pretty fun. Okay, not seeing anyone there. You guys have any closing remarks?
I'll throw out. It's always fun, kind of evangelizing, teaching folks about governance, especially common sense stuff or things that you would think are obvious, but isn't. One thing to think about here, and maybe well, I guess Mario too. I'm the only one that ever notices stuff. There's a director on this board that's an ex-Icon person that I brought on when Carl pushed for the spinoff of PayPal. And if anyone knows anything about boardroom settlements and activism, there's usually some pretty clear language when it comes to when you're allowed on the board and when you're supposed to go off on the board. And whenever you see a situation where there seems to be a long-time investor, especially an activist or former activist, still on the board when maybe the firm is no longer engaged at that company or has shares, you should probably ask yourself, should they be on that board? Because most of these agreements tend to have pretty clear cut, if not ironclad, requirements to step down. And it seems like kind of fickle or petty or not that big of a deal, but those sort of kind of like cut corners or just kind of ignore certain agreements tend to be a tip of the iceberg as far as potential issues to spend time on. But that consider that a little lesson as far as you should probably read up on the standstill agreements and understand or ask yourself why is this person still on the board today. All right, that's all I got.
All right, very helpful for us, and that's a great observation. So, I think I'm not seeing any questions in here. I think it's been a good hour plus, and let's all be in touch on the feed. Thank you, everyone, for joining, and thanks to my co-hosts. You guys could say the last word as well.
Yeah, thanks, Elliot. Thanks, Maria. Thanks, Mike. This was a lot of fun. I appreciate the time of the conversation, and getting heads together on investment ideas like this. It really feels like we all get a little bit smarter in the process. So thanks everybody for tuning in.
Yeah, I enjoyed doing this. We're doing it right ahead of earnings. I think all of us here don't really have a strong opinion. So if the stock's up a lot or down a lot next week, I don't think that was the idea here. It was kind of a multi-year look, couple different views of things, but kind of with a eye on, is this really is there a nice opportunity here for the company to kind of turn the page and kind of head in a new direction versus the most recent past. So kind of a long-term view, just to remind everyone there. And thanks for setting this up, Elliot. Good seeing you, Jason and Mike as well.
All right. With that, have a good one, everyone.